I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes with all of the big six Canadian banks at or very near 52-week highs, and two-thirds of them at all-time highs. Today, we'll check in on the Canadian banking sector and share where we see opportunity right now. My guest today is Motley Fool Canada Chief Investment Officer Ian Butler. Ian, thanks for joining me.
Great to be here, Nick, as always, and ready to talk Canadian banks.
So, as I said in the intro, Canadian banks really performing well. What is driving the strong run in Canada's big banks?
Maybe first, just a little tidbit on Canadian banks. Recently, Shopify has became once again regained the crown as Canada's biggest company by market capitalization. And any time that has not been a Canadian bank in that position, it has not worked out very well for the company that's taken that position. So it's just a little tidbit for people watching to have in mind as they sort of navigate the Canadian market. It's been an interesting little thing that I've seen over my career. But Canadian banks, they are doing obviously very well. So we've got Bank of Canada that's been on their side. It's Bank of Canada's cut the short-term interest rates down to 2.75%. That's at least buoyed the housing market more so than otherwise would be the case. Housing market is a big driver of the Canadian banks. I think there's pockets of weakness in the Canadian housing market, but certainly by no stretch is there a disaster of any sort. So it's just kind of they're just business is good on that front. Housing is a something that I think the market has been concerned about, and those concerns have not been founded. So that's good. RBC they've been active on the corporate action front. RBC is integrating their acquisition of HSBC Canada. Deal was done in 2024, and National Bank is integrating Canadian Western Bank as well. So some transactions on that front to help spur growth. And I mean, as always, these companies are just super solid on the balance sheet side of things. They're always well capitalized, and they provide a lot of appeal for dividend-seeking investors. Their yields maybe aren't what they were a couple months ago, but still, we're talking sort of in the 4% range for a dividend yield, which tends to grow over time. These companies that will buy back stock with excess capital and increase that dividend. So there's just always a lot to like about the Canadian banks.
Right. You think about the banks, often a lot of the macroeconomic factors that drive bank performance are common across the banks, but do have some idiosyncratic differences that maybe makes one bank a better value than another at a particular point in time. So, Ian, when you're looking at the Canadian banking sector today, which Canadian banks look like the best value to you right now and why?
Yeah, I think there's a couple ways to look at this. So we can maybe look at sort of the best in breed is currently arguably Royal Bank. I think TD has had its moment. They obviously came under some pressure because of some U.S. Issues with money laundering, so big fine there. However, that's also left TD in an attractive standpoint from a valuation perspective. I think if you sort of look at metrics across the board, TD might have the best package in terms of multiples, dividend yield of 4.1%. So TD's in the running. Royal's best of breed. Uh, I think another way to always approach the Canadian banks, and many follow this, is just to buy the worst looking bank or the worst performing bank. And in that case, it's Bank of Nova Scotia because these things tend to flip around. I believe not that long ago, Bank of Montreal was in that position, and it's had a great run of late. So Bank of Nova Scotia, one quick and dirty metric to look at to gauge a bank's performance is return on equity. Bank of Nova Scotia over the last 12 months is at about 7.9% ROE. This compares to the rest of the group, which is in the 12 and 13% range. However, this is reflected by Scotia's price to book multiple, which is the lowest of the bunch. I said that TD has the most attractive multiples across the board. If we zoom in on price to book multiple, 1.15 for Scotiabank compared to a group average of 1.7. So that it's not as profitable or performing as well as the others is well reflected by the stock price, and it's got the biggest yield of the bunch too. So as you can see, I'm dodging the question, and which is why for for our members in our advisory services, we have actually recommended that they buy all the Canadian banks. In three of our services, we've one ETF in our universe, and this is a Hamilton Enhanced Canadian Bank ETF. It owns all of the big six in equal proportions, and we think that's as good a way as any to handle this group of wonderful Canadian businesses.
Yes, if you're looking for best in breed, Royal Bank of Canada is probably the one to look at. If you're looking for mean reversion, Bank of Nova Scotia certainly has diverted from the mean, but you could certainly do worse than investing in a broad based ETF, which the Hamilton Enhanced Canadian Bank ETF is certainly one of those. Tickers HCAL on the TSX. Ian, thanks for joining us for this edition of the 5 Minute Major. Looking forward to seeing you again next time.
Thanks.